Okay, folks, welcome back. This is our midweek review for the week ending August 2nd, 2019. All right, so I have all the salient notes still on the chart pertaining to what we are anticipating on the upside for dollar index. Real quick, I just want to remind you that I promised that this would be a very short midweek review because I want to use the weekend review to kind of like go through the entire process and also have the non-farm payroll behind us as well. Okay, so don't feel cheated because it's a short one, but like I said, I'll have an order flow idea that really pertains to this unrealized dealing range concept that I shared with you last week. Okay, all right, so right away, it's finally been delivered to us, our weekly SIBI for the dollar index. 98.40 did get traded to. The high for today was 98.42. We did run the buy side liquidity pool. For those of you that are new, this level, we've been talking about that weekly chart being closed in. We've been waiting for this imbalance to fill in on the weekly chart for so long. It's been months and months and months. Finally, it wasn't until we had this break on the dealing range here that tipped us off that the central banks would want to reprice back up to the weekly SIBI. Now, notice as a recap, go back and watch the last couple market reviews. You'll hear me refer to specific levels in here, and each time we get to one of these levels, that's an opportunity for you to scale off something. Now, right away, you're going to think to yourself, well, how many, if my position's small, how do I know which one to take profits at? That part, number one, comes with experience. Two, you also want to allow yourself the opportunity to get something out right away. So the nearest PD array, or in other words, like we had the buy side liquidity pool above this high here, and just breaking out above the dealing range and waiting for that retracement, as we talked about in the previous recordings, that would be sufficient to take a partial, and then maybe look for the consequent encroachment of the SIBI here. Okay, that's what this level is here. It's the midpoint of the fair value gap between this candle and this candle, one single pass on sell side delivery. You could use the mean threshold of the order block, that's bearish order block, these consecutive up close candles. That's this level here. That would have been an area where you can take a partial off. You don't want to just simply say, okay, I'm going to take a partial off, unless you have a large enough position on. Obviously, you can do that, but you don't want to have so much expectation that every time we get to a new array or a new target on the upside that you start developing anxiety. That's generally what will happen, and I get a lot of those types of emails, even from the first group, the charter members that graduated into charter member in 2017. A lot of the emails I get from them is they are seeing the trades, they're getting in the trades, they're finding the setups, but their problem is right now is where to get out, where to take profits, and where to take partials. That is an evolving skill set. And like I said, I've been doing this for 27 years, and it's still evolving for me. Okay, I see a lot of things I can still do, but I settle in on the low-hanging fruit objective because it's just easy. It takes all the anxiety away from me. And as a mentor, I'm telling you, if you do that, take the easiest targets. Make it easier for yourself. Don't demand precision on your exits. Okay, you don't need that. In your analysis, yes, look for that to be there, but we don't need that as our exit. So we had a nice range expansion, clearing the buy side liquidity pool. As you can see, it's been dimmed a little bit, and I like to do that every time we have a level breached or touched, and we've done that. But really beautiful display of how the central bank really reprices after they tip their hand. Now notice this level in here where we have the unrealized dealing range. I want to talk a little bit about that when we get into cable, because I posted a chart on the forum, and that's the lesson we're going to talk about in this recording. So I don't want to spend too much time on this and steal the thunder from this weekend's full weekly review. So we're going to jump right over into Euro. Now, as you know, I had a short on the fiber market, which is Euro USD, at 111.67 and 6 pipettes. And I took 30 pips off and I took 50 pips off. So I was able to bank 80 pips out of the move, but I left the stop at my first scaling. So in other words, when I took my first profit off, I dropped my stop and I left it alone. Looking back in hindsight, I can tell myself that I should have left the stop above where I initially took the trade at and just left it alone there. But going into this week, I felt personally, that cable was really indicating that we were going to see higher prices on dollar. Eventually, the euro would catch up. I just had to weather the storm throughout this week. Was it frustrating? No, it wasn't frustrating because, number one, I took the 30 pips off and I took the 50 pips off. That's why I teach taking partials. Now, had I not taken anything off and I've watched it creep up, I saw this fair value gap here. And Troy, I saw your DM to me on Twitter. Beautiful entry. He sold short up in here. He kills it. And when he's dialed in, he does an amazing job. And if you just relax and let it continue like that and don't force more setups than you need, you're on the right path. Just don't do more than you're trying to do now. But nonetheless, I was looking for this fair value gap, as a potential area where I could get stopped out. But I look at it this way. If I get stopped out, it provides me the opportunity, number one, to prove to you that you don't need to worry about being stopped out, and it doesn't change the analysis. So I let it go. I watched London Open. I watched it trade right up in there. It killed my stop. No problem. Big deal. Then I just simply waited for the opportunity in the marketplace to give me another selling scenario. We had the market structure change here. So we took the market below here after closing in the consequent encroachment of the fair value gap. And I'm going to take this off so you can see it. That's the fair value gap, and we split it in half, and it trades right up into the high of 111.61 and 4 pipettes. Okay, so beautiful price delivery in London creates the high, and then trades, breaks the market structure. Then our focus goes back to, number one, I recorded that at FOMC release, the equal lows. So we have a very clear, obvious sell-side liquidity pool there. And then we have the low here from last Thursday. The draw on liquidity initially is going to be here. And then you have this low here. Now, the low comes in at 111 big figure. Okay, so if we trade down to that and blow through it, number one, the protocol is this. We're breaching a big figure, so that means we can see an expansion of 40 pips. If we see it trade below 40 pips, then it's going to run for the next institutional level, 50. Then we go to another process of, okay, if it hits the 50, then it may expand to the 20 level. Then once it gets to the 20 level, we can anticipate some retracement and then another expansion and take out another big figure. In this instance, we've had our weekly BISI for the euro market, and I'm going to scrunch this down. Okay, that's where price is trading now, and there's our weekly BISI. So 110.20, that was a level. And go back and watch the recordings because, again, if you're new and you're watching this, this is all going to seem like I'm just slapping this on the chart now because it looks good. Okay, but there's thousands and thousands of people in here that'll tell me that I'm a liar on Twitter if I'm telling you this stuff and it wasn't there beforehand. Okay, so we know that this was a likely long-term draw, and I still feel that that is likely to occur, especially after today's price action. But we don't know the uncertainty with the non-farm payroll later in the week. So we might get some kind of really deep retracement, or preferably I'd like to see it not really retrace. I'd like to see it stay down in this area and then use non-farm payroll to plunge it lower, hit it, and then it caps the week and we're done. Now, I'm not saying that calls the bottom in euro. It just means that that would fulfill our weekly objective on euro dollar, since we've done so on the dollar index. Euro might be allowed to participate and trade down and rebalance to that 110.20. Now let's go back up here, and we have market structure break here on this candle. It breaches it, and then right in here, very important for order flow. The bearish order block which is the last up close candle right here, the low comes in at 111.50 and 5 pipettes. So right in here, this level, when it trades to it, that is a sell after rebalancing here. Now this wick right here, this may confuse you. You may look at this and say, okay, this wick's low and this wick's high. Really, there's no fair value gap. It is because we have a break in market structure that takes the analysis and sets the precedence. We now have a market structure break. Return back to the bearish order block, reasonable. We have an imbalance of sell side delivery, buy side inefficiency. So we have a SIBI there. Disregard this wick. Okay, we have to look at the break in market structure. That's the real context. Okay, so the algorithm will want to go back, seek to rebalance to the bearish order block, and then distribution on the downside. Price makes a nice run, running below equal lows in here, retracement, and you watch me record the live view of them setting up the run on the sell side liquidity here, and then the sell side liquidity pool resting below here, noting that 110.90 would be the level they would want to sweep, and to do that they got to go below 110.90. That's 10 pips below this low, big figure 111, so 110.90 is the next level that we would look for liquidity. Now obviously on Twitter I'm not trying to teach mentorship, I'm not trying to teach all facets of what I do, and 10 pips below that is sufficient. People understand that from the free tutorials. They are not aware of that level down there as the long-term draw. So we have that. Let me scrunch this up a little bit more, put some distance between it. Notice that we have a nice run initially here, and then we open back up here, and then we plunge one more time below it, open here, make a low, and then we rebalance up to this price point here. Again, that same idea we did with the market structure break here, and that wick right there, disregarding it. We disregard this wick. We don't use that low because it's breaching a level that's more significant. This is significant. Liquidity is resting below here. They worked this level, ran it, sent it back up. Okay, this long wicked candle here on there. Okay, that long wicked candle, traders seen that as, okay, this was the run on the stops. They can go in there and start chasing and buying it. Not a good idea. Price expands again, dips below it again momentarily. Then we open up here, trade down deeper. There's your imbalance. This candle's high, or in this case, it looks like the open, the same thing. Yeah, the open and the high is the same. To this candle's low. Okay, 110.996, which is essentially what? The big figure, which is really what it bumps back up into and hits it. This is where your support and resistance ideas work, where you have an imbalance and liquidity as a draw down here. So as a low, we have not yet traded to the 50 level. So we were just under 10 pips shy of hitting it. I think that it should just be real messy in here, if anything, and then trade through it. Ultimately, I think that the ideal scenario, if I were running fiber price delivery, it would be just a sloppy mess in here, and then using non-farm payroll to facilitate the run down to close 110.20. That's what I would do. I wouldn't trade it from here. I wouldn't touch it now because we're so far imbalanced. Don't do anything with it. Just study it and practice it. Obviously, you know the protocol. Thursday and Friday is a no touch because of non-farm payroll. We've added the FOMC to the reasons this week because of the economic calendar. So Monday and Tuesday, okay, I had a nice move in cable, and I caught 80 pips out of euro, and then I got stopped out, and then I did more entries. Now, if we know that the dollar index has already fulfilled its weekly objective, is it done? No, because if you study the weekly chart on the dollar index, you can see there's still several, I think it's a volume imbalance also you can find on your weekly chart for the dollar as well. And it doesn't mean that this is the high. It just means this was a very logical level for the price to be rebalanced to on the heels of FOMC. So it's not random. They use these things as smoke screens to hide, but they go exactly where we anticipate them to go in terms of analysis. So IPTA did its job beautifully between dollar and euro. Let's move over real quick into cable and wrap this video up. All right, so here's the new week. I tweeted a chart. No, I didn't tweet it, rather. I posted it on the forum in the news section under ICT Mentorship announcements. So if you're a new member and you're not checking that thread out, you need to do so. I put a link in the top of month one's content, so it'll take you right to that area. And kind of like use that as our Twitter. I don't want to do too many things through Twitter, but I got a couple emails saying that while I do post it to the announcements thread, it doesn't really timely email them. I thought that it would do it as soon as I posted it, but apparently it doesn't. It emails you, I think, once a day if there's any changes in the forum, like whatever updated threads are. I was thinking it would be faster than that, so I'll still post to that thread. Okay, again, it's the news thread, and then once you click on the news thread in the categories, once you open up your form, go to month one content. It's the easiest way to do it. Go to month one content, top of the page of month one, you'll see use this for ICT mentorship announcements or something to that effect. Click on it, it'll take you right to the news category and the ICT mentorship announcements threads. Well, it's one thread, but it's 2 pages of posts by now. I'll post the things I want you to be aware of, but I'm going to still have to tweet the link to kind of like make it more timely. So I apologize. I thought it was more timelier than that, and it doesn't do it. So nonetheless, you'll see it, and you'll get an email when it was done, so nothing can be manipulated. It's all there. And plus, when I tweet it, somebody's immediately there already looking, so it'll never change. I'm never manipulating or changing any of the charts. Once they're there, they're there. Either I'm right or I'm wrong. Okay, so just know that I posted this, and I wanted you to study it. So what I wanted you to see is what I did for the dollar index last weekend, and I outlined how high probability scenarios work, and I introduced the unrealized dealing range. If we go to the cable market, the market closed with a low on this candle here. That's what I'm highlighting. Okay, and even if you don't have Sunday candles, okay, you could still use the high on Monday. Okay, so don't think that it has to be like splitting hairs, because it's not. But I said to you last weekend, before the market started trading again on Sunday, I said, ideally, I want to see the market remain heavy here and just roll over. They were my exact words. Okay, that's what's in the video. Go back and listen to it. You'll hear it's exactly that. We opened on Sunday here, we opened here and traded up to this high. So we closed in the gap right away. It was a minor gap, but nonetheless, it was a gap. I used the candle low here as my point of reference. So now we have this level, or again, you can use the high on Monday. It doesn't change anything. It doesn't change it. And the level of 123, which I said was the next downside objective. That's the next downside objective. That was not the low. That was not the all-time weekly low. That was not the ultimate low. Okay, that was just the next draw on liquidity. If you take the fib and you do the same thing I taught you relative to the unrealized dealing range example on the dollar index daily chart. Here we have this level, and anything above this level here, back to that level, and it's going to fight me because it wants it automatically. This is driving me. It may not have drove you nuts looking at it like that, but it drives me nuts. OCD kicking in like crazy. So that low to the 123 target, okay, that's just an initial target. That means we have a dealing range to work within. All right, so right away, anything in this range from 50 to higher up to here, if we get a premium array, that's a bearish order block, fair value gap, a breaker, optimal trade entry sell, a run above a buy side liquidity pool, something to that effect, a bearish mitigation block, whatever you want to use that's in price. It has to be in price. You can't just assume it's there. It's going to be there or it's not. So right away, your eye should be going right to this level, right there. Okay, so there's a fair value gap there. This candle's low and this candle's high. All we need to do is see price trade back to 23.71 and 9 pipettes, and then 72.9. So actually went 1 pip above. There's your entry. You can go short. What makes it high probability is because we're in the upper portion of this 50% of the unrealized dealing range. So this is the ideal scenario for entry. Price declines and then comes right back up to the 50 level. Now notice that it's coming back to this 50 level and a fair value gap right in here. Wait a minute, Michael. This candle here and this candle here, this went lower. Yes, it did. Go into the lower time frames. You'll see a bullish candle in here. In fact, let's do it because I know what you're thinking. Can you just do it? Show us. All right, so in here, in this little area that's white, we're going to see, let me actually make it a little bit bigger than that. There you go. And I'm going to change the color so that way we get a full contrast. There we are. All right, so I'm going to drop into the 5-minute chart. All right, so here's the 5-minute chart. So we have up close candles. Okay, inside these up close candles, if we take that range, low to high, here's our level right here, 50. So if I take a horizontal line, drop it right on the 50, eyes are not doing good here. You can see it trades right up into the mean threshold of the bearish order block. We can clearly see the fair value gap in here on a 5-minute chart. We have a low, a high, beautiful delivery, back to the 50 level, handsomely done. 1, 2, distribution. Okay. We also, if you look at it really, really close, you can see that we had a breaker here. If you go into a 1-minute chart, you can see it even better. But you have a high, the low, and a high. Price returns back to the low here at 23.31 4 pipettes. And that is seen here. The high is 23.31 and 7 pipettes. So it went 4 pipettes or 3 pipettes above to hit it on the open, trades up, hits the bearish breaker rather, and then distribution again, targeting the sell side liquidity below here. We have price having a nice expansion on this candle, and then small little fair value gap right in here. All it needs to do is trade to this high, 23.10 and 6 pipettes. Beautifully done here. Went 2 pips above, closes the gap, handsomely done. Distribution, running out the 123 objective. So you take profit or scale off something here, and you leave something on 23. So if you know you hit a big figure, we can see expansion of 40 pips. If you're not taking notes, folks, you're not doing yourself any service at all. Just hearing me talk about it is not the same as writing it down and having it ingrained in your thoughts and memory. You have 40 pips here. Okay, so price makes a run to 40 pips here. It goes a little bit more. Obviously, it's not a big deal. But inside those 40 pips, look what we get here. Fair value gap. Price comes back up, fills it. Stop would have to be above here. Do you get stopped out? No. Price runs lower, creates another fair value gap here. Let's go back out to a 15-minute time frame. So we have that fair value gap. Our day dividers are in. Price consolidates from the 30th into the 31st. And then we have the market trading down into a bullish order block right here. Imbalance, relative equal highs, and a fair value gap. Price trades up into it here in the New York session today. FOMC later in the day, we spike up into it. One more time, opportunity expansion down into liquidity pool and bullish order block again. And this is where we're at for the remainder of the day at the time of this recording. So what are we saying here, or what am I trying to draw your attention to? Is the unrealized dealing range is a way that we use, or the way I use, when I talk about a specific level. You want to run your range based on where we are right now and where it is likely to go based on my experience and my commentary. Split your range in half, and depending upon the directional bias, in this case, we were bullish dollar, bearish foreign currency, British pound should be going lower. And I mentioned specifically the 123 level. So we can split that level in half, or that range rather, and then if we get any kind of bearish PD array up here that overlaps with a specific time of the day, like a kill zone like Asia or London Open or New York Open, then you have a real opportunity to look for a setup to unfold, driving into the terminus of the unrealized dealing range, which is, again, it's just one level. It's just one level to work within. Now, you can use this framework to get in sync with the longer term trend, or you can use it to day trade, or you can do it as a one shot, one kill. It depends on the overall market condition. So, as I indicated last week, I said that the Wednesday review, I stated that I was more interested in going short on Euro, but that changed on Monday. I'm sorry, it changed on Friday when we had this area in here. It was beautiful delivery of price, rebalancing here. Everything changed as I outlined in the weekly review from last weekend, that the cable became the better selling scenario. But I had something on the line in the market, and even though I did some shorting in cable, I did not relinquish the trade I had on the fiber market. And I had to endure getting stopped out, and then just used everything I teach you to get in sync with going short. Now, I already know you're thinking, you overshot the, what did you use to get short? In the video, I'm highlighting this breaker, okay? This breaker is, the low is 111.37.4. So 111.37.4. And that's right there. Okay. So I'm looking at that. I'm looking at the fact that initially we had a fair value gap in here that did close. Remember what I stated before about fair value gaps. You don't ignore them, because IPTA will go back and use that as a rebalancing point. In other words, we have a fair value gap and a breaker. Price does its work and moves away, yes, but then it pumps up into the FOMC release. This is what I'm highlighting right below here, and I'm not drawing attention to it on Twitter, but it's the fair value gap being revisited. Okay, so much like I teach the reclaimed order blocks, the fair value gap will act in the same manner. It will act as a reclaimed bearish order block. In this case, even though there's no bearish order block here on this time frame, the opportunity is, when it trades back to that, anticipate the expansion on the downside, as I shown on the chart before it happened. Also, you can do the high to the low and get the optimal trade entry if you want to stick to that too. If that's going to be your pattern, fine, no big deal, no arm twisting here, but that was the criteria behind it. Real simple, real short and sweet, nothing real magical. Everything I've taught you so far in the mentorship is applied in here. Equal lows, sell-side liquidity pool, and that long-term BISI on fiber is still unrealized down here. Okay, so we blew out this low. We're looking for this. So now that same thing can be applied going forward. We have our range from here to here. Study, if you get anything in here bearish from this level higher, then you have something you can practice and paper trade. Do not demo trade it, paper trade it. And then we'll see if we can get some erosion down into 110.20 before the close of this week. That, my friends, is going to be it. I will catch up with you by way of the forum if I give you anything ahead of the non-farm payroll as a study, not a trade, as a study. And otherwise, I'll talk to you this weekend. Saturday, 4 o'clock, I'll be sitting down to do the weekend review. So between, I guess, 4:30 and maybe 5:30, it should be online. So as a heads up, enjoy your weekend. Don't go to the forum keeping tabs on when I'm posting it. That's when I'm posting it this weekend, okay? And enjoy your weekend. Enjoy the rest of the week. It's a short week now, non-farm payroll. Just relax. Don't take any trades. All right? Talk to you then.